Hi guys, today I had the privilege of sitting down with Mr. Dominique Jooris, who's had a fantastic career to date within the banking sector and is now embarking upon a new chapter, entrepreneurialism. Growing up in Belgium, he first moved abroad to London where he worked with JP Morgan before commencing a 5-year period with Lehman Brothers, both in the UK and then in Tokyo. Latterly, he spent over a decade with Goldman Sachs, both in the UK and in Hong Kong. And then most recently, he made a transition to private banking where he worked with Pictet here in Singapore for 5 years as their CEO. I'll let Dominic share a little bit more about his new entrepreneurial journey setting up WM Cockpit. It was an absolute pleasure, and I hope you enjoyed the discussion as much as I did. Thank you. Well, DJ, Dom, the Godfather, it's a pleasure. Thanks for being here today. I wanted to talk about your career. You've had an illustrious career and what you're doing now in business. But if you can, for my audience members, can you be kind enough just to introduce yourself and a little bit of your background, and then we'll get stuck in.
First of all, thank you so much for hosting me in this great setup. And it's fantastic to be able to continue to exchange in a slightly more formal format. But it has been quite an experience to be connected with you over the years and exchange views, perspectives on people, markets, businesses. It's really been, you've been a very valuable source of information, a great sounding board. So starting with thanking you for that.
You're very kind. Thank you.
I was blessed in the sense that I've had the opportunity to start what was a very Belgian life. I was born in Belgium. I studied through high school there. I went to university there. And then very quickly I was offered to move out of Belgium to join JP Morgan in London, which back in the mid-90s was a dream come true. JP Morgan was still a AAA bank in those days. It was very white shoe, blue blood. And the experience was amazing, together with an extended training program, which has all but disappeared.
Yeah.
You would be sent for 6 months in New York, all expenses paid, to be trained, to have MBA teachers coming and try to fill the gaps in your education. There was already an incredibly diverse pool of people joining those programs. You did not need to be a major in finance to be able to join JP Morgan. You could have studied geology, you could have studied political sciences, you could have studied physics, which a number of people did. It had obviously a very quantitative angle to it. The pool of people that you met and that you create relationship with at the beginning of your career was an asset that kept on yielding returns for the next 30 years. It was an amazing experience. I had the opportunity to spend 5 years with JP Morgan, mostly in London.
Where were you living in London?
I was at the
A few different places?
Living in just off Sloane Square.
Beautiful.
A shoebox apartment, but a stone throw away from the Sloane Square tube station.
Yeah.
Which was, of course, very convenient to go to Blackfriars, where JP Morgan's offices were then. And, of course, as soon as the family started to expand, we had to move in the Badlands of Fulham. And, of course, the commute was a little bit longer, but at least we had a place for a nanny and a room for our daughter.
Well, Fulham has become a bit more gentrified over the years, right?
It was not rough, but it was definitely a little bit off the reservation back in those days.
Yeah.
You're right, it kept on improving.
Well, certainly compared to Sloane Square, you were spoiled, right?
What can I say? At least we could own in Fulham. You could never own in Sloane Square.
That is very true.
Especially in those early days.
For sure. And then tell us about the rest of your journey after that 5 years.
At JP Morgan, after 5 years, having spent some time in the M&A department, in the structured credit department, and in the capital markets department, the debt capital markets, I was pigeonholed into covering Belgian institutions. And that's where I had a profound doubt moment, because the reason why you want to work for those international firms is to get that broader perspective. And the fact that you were pigeonholed back to a market for the simple reason that you held this passport and spoke the language was at odds with the idea of, London is just a stepping stone to go to New York to do some fantastic things. And so I took the decision to leave JP Morgan. And bear in mind, we were in 1999. This was the run-up of the internet bubble, the telco bubble. And I joined a very small firm called DLJ, which had a structured finance department who was, among others, engineering special off-balance sheet transactions for some pretty aggressive companies in the US. Enron was probably one of their clients. And so it was in those days.
I met the CFO of Enron, by the way. It was interesting.
They were doing things that were, of course, legal, but incredibly aggressive.
It's on the edge.
In terms of providing leverage to Enron off-balance sheet. You are right. It was sailing very close to the wind. And of course, history won't, in those cases, forget the losers and won't penalize the winners for having used that type of technology.
Well, sorry to interrupt you. Just an interesting point. So that gentleman ended up going to prison. And he shared that he only realized maybe, I think, 6 to 12 months into prison, what effectively he had done wrong, because earlier that year he was given an award for being the best CFO in the US. And he felt for those reasons he was still put away. And I think he realized that it was really a moral dilemma of what transpired. But yeah, it must have been very interesting times for you.
It was a remarkably buoyant environment, and one where you would not have hesitated to trade a brand name like JP Morgan, and in those days probably a career for life or something close to that, for a much more aggressive boutique like DLJ. The market was so crowded, all the investment banks were in some shape or form conflicted for the big M&A deals, and there was some business to be had by the likes of DLJ. So it was an exciting time, which came crashing after 9 months because Credit Suisse took over DLJ. It was probably not even the first, but it was one of the many blunders that Credit Suisse did. Of course, DLJ was very famous for their high-yield capabilities in the US. It was a decent fit with Credit Suisse. But in Europe, whatever DLJ was offering was redundant with the Credit Suisse capabilities. The writing was on the wall. There would be some indiscriminate firing of the new kids on the block in favor of the incumbents. And so there was a diaspora of DLJ into Lehman Brothers, into other firms, but Lehman was definitely a big recipient of that. It brought to my attention for the first time the tribal nature of the financial services industry. And when I thought that investment banking was tribal, I was still in for a surprise when I joined a private bank, but that comes in a few minutes. The tribal nature of the group of people who work together in high-pressure situations cannot be underestimated.
Yeah.
So off you go, 5 years at Lehman Brothers, 4 in Europe, where I was lucky enough to be put in charge of the financial institutions debt capital markets group, and in particular the structured products, the hybrid tier ones. My claim to fame is that I raised the first hybrid tier ones for German Landesbanks, who were capital constraints in those days, could not obviously IPO themselves, but they needed to find tier one capital to fund their expansion. And through a pretty sophisticated tax and accounting, as well as regulatory and legal structure, I managed to create the first hybrid capital instrument for those Landesbanks. We ended up having an 80% market share because we had a technology and a track record that others couldn't simply compete with. And
what was the culture of Lehman back then? Highly dynamic.
It was swashbuckling. Must have been the right adjective.
I love that word.
It was incredibly dynamic, no holds barred. The goal of Lehman Brothers was to catch up with Goldman Sachs, and of course, with the rising tide lifting all boats, with the ability to put on virtually unlimited amounts of leverage. Lehman Brothers was doing that, was appearing on the radar screen, was pushing itself into the bulge bracket investment banks. It was a remarkable time. There was, however, no hiding the fact that the very senior management was out of its depth when it came to the more strategic or technical sides of the business. This is a point that I'd like to come back to.
Please.
But there was a point where, as long as it was all plain sailing, the firm could perform quite well and had built a name for itself. When the waters got choppy, that's when the wheels start falling off the cart. But by that time, I was gone. So I spent the first 4 years at Lehman Brothers developing those very complex tax accounting-driven structures for essentially German clients and later on further European clients. And then I was sent to build the debt capital markets business in Asia. Asia, for Lehman Brothers, was the result of some American guy looking at the world and saying, well, Asia must be Japan, right? That's where all the Asians are, putting a finger on the map and say, our Asian headquarters are going to be in Japan.
Wow.
So I moved to Japan, realized very quickly that from a location perspective, it was a difficult place to be. The domestic market was just that, domestic. And as soon as you wanted to venture outside of Japan, it was an 8-hour flight. It literally, the unit was 4, 5, 6 hours. You want to go to Hong Kong, it's 5, 6 hours. You want to go to Singapore, it's 7 hours. You want to go to Korea, that's a bit more reasonable. You want to go to Beijing, it's another 4 or 5 hours. And so the location was not conducive to expanding a business in a seamless way compared to Hong Kong. But also it was clear that the firm in those days was just focused on making proprietary trades. They derive 90% of their business from buying distressed assets on the cheap, of course, and flipping them after a year or two, making a 5x return on those. This was miles away from the traditional corporate finance business, build relationship, engage with clients, gain their trust, show off your capabilities, and be hired for specific corporate finance, capital raising, advisory transactions. We were miles away from that. And it was pretty hard to see how that business could evolve into something more corporate finance minded. After all, if it ain't broken, don't fix it. They were making those proprietary returns quite regularly over the last 2 or 3 years. There was no need, there was no appetite to try and look at clients for the long term. You just want to talk to the guys who were ready to sell distressed assets. So after 12 months, I realized that Japan may not be, and Japan at Lehman Brothers may not be the right answer. And I was lucky enough for one of my clients to recommend me to Goldman Sachs.
Wonderful.
As in those days, I'd genuinely been the expert on that German capital markets scene, and it was not too easy for Goldman Sachs to do some due diligence and hire me for that purpose. That was the start of a decade-long career at Goldman Sachs, where I started in Europe developing those hybrid capital products and then running the debt capital markets financial institutions group. After what, I was asked to move to Hong Kong to run the debt capital markets group for Asia.
What year was this when you moved to Hong Kong?
It was 2009, so it was in the aftermath of the great financial crisis.
Yeah.
And then I was very lucky to find myself at a time where Asian corporates were starting to consider those more aggressive structured finance, perpetual instruments that would be counted as equity for rating agency purposes. It was literally a watershed moment, which was materialized when Hutchison Whampoa raised a $2 billion perpetual bond through Goldman Sachs alone. That was a transaction that was extremely profitable for us, and that put my group there and the value of that effort on the map. Goldman Sachs, again, it was a house that over the years had made a lot of money and had a preeminent place in the equity capital market scene, IPOing the large Chinese banks. But while debt capital markets was the poorer cousin, they realized that there was some value in doing that. There was some kudos value, there was some league table value, but there was some hard dollar value as well. So I spent more than 10 years at Goldman Sachs in total, 5 in London and another 5 or 6 in Asia, before being offered the opportunity to join Bank Pictet Asia in Singapore as the CEO.
How did that come about? Because I know when anyone's considering leaving IB to go to private banking, there's a lot of consideration, but I'm curious, how did that come about?
I had the feeling that after 5 years in Asia, in the role that I was in, I was plateauing, and I didn't get the message or the vibes that I would make partner at Goldman Sachs from that seat, which is, if not a death knell for your career, at least is a sign that you may linger for a while in that role and be offered to stay. But you were definitely not ready or seen as being ready to make the next step in your career. You need to read the tea leaves there.
Yeah, may I ask, because reading the tea leaves is not easy, right? A lot of people come to me and they're trying to anticipate, like in Goldman, if you're being put up for promotion to MD, but it's every 2-year cycle. You know, do you stay? What happens if you don't get it? You miss the boat, or do you leave? So reading the tea leaves, can you walk the floor? Can you engage some senior people to get a sense, or you're really having to feel the pulse of the situation around you and read the room, so to speak?
It's a brilliant question because it's so difficult to answer generically. Let me offer you my take.
Please.
I do think that banks in general, like any commercial organization, will try and get the most of you at the lowest possible price. They will be interested in promoting you and keeping you if they think that there is a future value to that increased cost, that they may need to pay you more, you may need to be there for a few more years, and so they will want to get some extra return if that happens. But when that promotion doesn't happen, there will, of course, be some attempts at appeasing you. Of course, you will have a lunch with the most senior guy in the office, in the region. Of course, when you go to New York, you will have your 15 minutes of fame with David Solomon or whoever. But it doesn't take away the fact that that thing did not happen.
Correct.
And you need to be brutally honest with yourself. You need to be able to put aside all the ego stalking that taken place and say, what is the actual message and what do I feel? I felt, for one, that I was not considered for, say, returning to London or a career in New York. I was probably seen at that stage as too much of an Asian hand, and it's one of those situations where I could have stayed a few more years and probably seen my package slowly decline until there is a downturn and then the axe falls. Instead of that, you need to say, well, I've got a skill set. What should I do with it?
Yes.
And let's look around. This is not disloyal. This is not dishonest.
Yeah.
This is not something that you should do with the cloak and dagger approach. I'm not saying that you need to broadcast it, but you do need to take active, positive, conscious steps to try and say, assuming that there is something better out there, what would it be? The investment banking universe at that time, I'm talking about 2016, was probably not in the expansion that it had been for the previous 10 years. And I had the opportunity through a headhunter to be considered for the position at Pictet.
Wonderful.
I need to tell you how it happened.
Please.
I'm having a discussion with one of your friendly competitors.
Yes.
I can still see it. It was at the now defunct restaurant in the Prince's building.
Okay.
And he had invited me for lunch to gently poke what were my staffing needs for the year to come and what type of candidates I would like to see. And I told him, we are, if not in hire freeze, at least we're not actively hiring. We have a full house at this stage. But if I may ask you, what are the mandates that you're working on? Would there be something that could be of interest to me? These were my words.
So he didn't approach you with the role in mind at first.
He approached me to try
to hire
and
help you hire.
offer me some candidates.
Yeah,
I turned the tables in
I love it.
as blunt a fashion as I just did for you. These were probably my words. This was a quote. And he said, well, nothing that would be interesting for you, but the most salient mandate that I have is to find a CEO for a Swiss private bank based in Singapore. And I was like, oh, hold on a second here. I've done banking all my life. I told you about these early steps in my career where I was developing those hybrid capital products for banks. I was pitching banks. I was looking at banks' balance sheet. I've obviously been involved on the sell side for bonds and selling products, sometimes to institutional investors, sometimes to their private banks. So I had seen many facets of that business. And I threw my hat in the ring. They had a long list of 40 candidates, a short list of 10, a short list of 2 or 3, and I ended up getting the job.
Amazing. How do you know those were the numbers? They shared that with you.
They shared that with me.
That's real, by the way. It sounds very real. It's legitimate.
I was elated.
Yeah.
Now, the bad news is, literally, my package halved.
Yeah.
But the lifestyle was a completely different value proposition.
Yeah.
We can come on to that a bit later. But that's what took me to Pictet. The Pictet experiences lasted 5 years.
Yes.
These were amazing professional years. I must say that there was a lot to do in private banking. There was certainly more judgment to be applied than technical skills. But judgment comes from experience. Judgment is technical as well. A short parenthesis on that. Investment banks and the job of investment banking is usually incredibly technical. You need to have the best mousetrap. You need to have the best bond product to know which investor is going to buy your bond at what price, in what jurisdiction, and why withholding tax won't matter. It's very technical. On the other hand, compliance is something that, in theory, you don't worry about. I'm not saying that's not important. I'm saying that it's so important that there are an army of people that have the answer to any questions. There are safeguards, and unless, as was sadly proven in the 1MDB story, they can be circumvented. If you don't want to circumvent those safeguards, they will be there and they will protect you. You have any question on compliance, you call 0800 Compliance New York, and there's a guy picking up the phone 24/7 in New York and will give you the yes, you can do it, no, you can't. A yes is a yes, a no is a no, a yes, you're safe, a no, don't do it, and your career will be fine.
Bang.
Yeah. Moving to private banking was literally the mirror image of that, the negative image.
Yeah.
The technical side is not that demanding, but the compliance side is immensely complicated. The regulators have put on layers over layers of requirements for you to comply with: suitability, KYC, source of wealth, which is obviously the first part of the story, and then the human side of it. Do you decide to onboard a client? He is a member of the Chinese Communist Party, but he has made his fortune in a manufacturing industry in Vietnam, and he's based in Singapore, but he's a tax resident in Taiwan. How do you handle that? And ultimately, there is a judgment that needs to be made. Yes, I open an account for that person. No, I don't want to do business with that person. And the buck stops with you.
Yes.
There is no rule book. It's experience, it's judgment, and ultimately, the decision sits with you. You sign the client acceptance form or not. The two businesses could not be more different from that perspective. And it was a blessing to be able to come with a strong background, a strong technical background, and the corporate finance approach from the IB.
Yeah.
But then to have to quickly adjust to that whole very regulatory and compliance-driven environment of the private bank.
Well, fortunately, you had a couple of decades of experience, but I'm curious about that. I call that process rational deductive logic, because when you're facing that heat, and you've got really nowhere to go, you've got to sit down, you've got to process everything before you make a decision, right? And that can be a little bit daunting, because the challenge is, if you don't open the accounts and you're not being commercial enough, you're not doing good numbers. So that's the dichotomy, right?
Absolutely. That's the balance to strike. So back to your earlier point about career evolution and change, there is one thing that I've noticed there, and it will be relevant for the last stage of my career, the one that I'm currently in. Not say the last, it's the current one.
You're still young.
You do need to, when considering a career change, rely on 2 legs of the stool and just change one at the time. The 3 legs of the stool are the firm that you work in. The second leg is which jurisdiction or which region you work in. And the third one was what expertise do you have? When you want to change career, my advice and my experience was that the most successful changes are the ones where you just change one of these 3 legs. My most successful change was to go from Goldman Sachs debt capital markets in London to Goldman Sachs debt capital markets in Hong Kong. You change one of the legs of the stool. The subsequent change, which doesn't look natural and doesn't happen that often, is to go from investment bank to private bank. And there I was changing 1.5 leg of the stool. I was doing debt capital markets of financial products at Goldman Sachs in Asia, and I did private bank at Pictet in Asia. I still kept the Asian component and the financial structure component.
Yes.
I wasn't going out on the limb. But the best changes that you do are those where you just change one thing. You do the same thing in the same region with a different firm. Or you move within the same firm and change region. Or you move jobs within the same firm, but you stay in the region so that you can keep your nexus. Change one of these 3 stool legs, and you'll be incredibly successful. You minimize the risk and optimize the upside. It's
such a wonderful analogy and a great explanation. I speak to so many guys that are up and coming that, they're so fixated in becoming a managing director or working for a bank that pays transparently. And I unpack that. I said, look, when you get MD as a title, after 5 minutes, you'll realize it wasn't that important. When you earn $1 million for the first time, you'll realize it's not that important. I think if you push too hard, actually a lot of these things you won't get, right? So for if you're a top flight practitioner, it's not a case of, if, it's when. And sometimes I think people try and rush things a little bit too much. I spoke to a couple of bankers yesterday that, are only interested in working for firms that pay on a transparent formula. And I said, well, before you even go there, let's just pretend money is the same, right? Then you've got to think about, what are you selling, right? So if you're selling Ferraris versus a Toyota, or you're selling a fleet of cars, you're still selling cars, but, it's a completely different product in theory. And I think some people are so eager thinking about the back end and what it means, then they get lost. I'm curious, because you've always struck me as someone who's highly introspective. Did you always have aspirations of becoming a CEO? And if so, or if not, when did you realize? Was it only when you got the phone call, or that you had the discussion about Pictet?
The function was never an objective in its own right. The thing that keeps me awake at night when I think about my career is whether or not I'm utilizing to the maximum the skill set that I have. And if you do, you will gain experience. You will find yourself in a position where that experience puts you head and shoulder above your competitors within the firm or outside of the firm. And this is what you need to strive for. Good things will happen from there.
Yeah.
But you do need to strive for that technical excellence. And if you're not good at a field, find something that you are a bit better at. Just reorient yourself a little bit. But find that place where in the market, when people say, I need to talk about hybrid tier 1 products to somebody, or I need to talk about what I can do on the wealth tech front to somebody, you want to be the first one to receive that phone call.
Great.
After that, call me managing director, call me Mickey Mouse.
Yeah. Who cares?
$1 million or $2 million.
Yeah.
It doesn't matter anymore. I'm going to add on to that the fact that when you move a step up in your career, when you have a managerial responsibility, you don't need to be called a managing director or CEO to have a managerial responsibility. But when you have that, you do need to have enough of a technical edge so that you don't know everything. It's impossible. But you know where and who to ask the right questions to. You need to be able to feel where there is something that is missing. Find the right specialist and plug that gap. But you need to have that intuition. That's what good managers do, is that they bring people who have 95% of the capabilities. They identify the 5%, and either themselves or because of the people they can find, they help to plug that gap and make the 95 100, and you get the deal done. This is what your skill as a manager is, but that skill is not there because you get a new business card and a new title.
Right.
You do need to have that technical knowledge. And I believe that if you had the opportunity to interview, and I hope that he will come and sit in this chair, but if you had the opportunity to interview Jamie Dimon, you would find that this is such an individual. There may be an incredibly complex financial institution under him, but he's been running it for years.
Yes.
And he will have a pretty good technical grasp of pretty much any issue, from funding to credit card defaults to his own credit spreads. You will find that a good manager is just not somebody who has that generic well-being and benevolent attitude towards its employees. You do need to have that technical oomph.
For sure. I think what's interesting, and in the old days, to get a managing director title, it meant that you had to manage a group of directors. So normally there was something that came with that, i.e. the critical mass, the volume of the number of people you manage. But I think in private banking, where the business is a little bit smaller, you have a lot of people with inflated titles. And I think that the challenge is that most great independent bankers at some point yearn to do more. So they go from being an independent banker to a team head to a market head. And there's a real challenge in leaving that independent rainmaker mentality behind and embracing that leadership mentality. It's not easy. And I think that's when you need, good leaders or a good mentor that can help guide you that journey, that have walked those steps before you. Did you have such leaders and managers? And what have you learned from the people that have walked before you? And how do you inject that into your approach to managing people?
I've tried to be as good an active mentor as I could be to a number of people. I've tried to do that consciously and selflessly. I may not have over the years attracted a lot of good mentors. Maybe I was not mentorable material.
Did you try though? Did you try?
I did try, and actually one of the persons that I would label regularly as a mentor, for instance, at Goldman Sachs, recently retired, and although we had no personal chemistry whatsoever, he was one of the guys who could give it to me unvarnished.
Beautiful.
And that had an immense value. And we had that discussion, and we agreed that we had no personal chemistry whatsoever. And he knew and understood my business. No two ways about it. I was reporting to him a couple of layers down. And he was always giving me the hard truth, which had a value. This was not a nice, let's go for lunch together. I'm sure he would have hated it. But when I would ask him something, he was appreciating me enough to just give it to me as it was. And on the other hand, I was confident enough that even if we had no chemistry, even if we had no personal connection, I could walk into his office and say, hey, I've got a problem. And generally, he would tell me that the problem is with me and that this is not something that can be fixed. But he would tell that to me point blank. Mm-hmm. That had an immense value. What I'm driving to here is that mentors or managers are not these type of ethereal, benevolent figures that are going to bestow their blessings upon you, put some cushions under your feet and lift you gently to places that you don't really deserve to go to. That's not what a mentor does. A mentor is somebody who allows you to look at yourself in the mirror and say, oh, I did this wrong. I should improve on this. And this is what this is what I should gun for. This is what I need to strive and improve. It doesn't matter whether the pill is hard to swallow. Just find the guy who tells you that.
Yeah, I completely agree. I think it's tough because to find a mentor, the person has to be at the right time in their life where they can afford to give you some time. They have to be confident enough to give it to you straight. And, sometimes you have to care about someone enough to at least share that wisdom, because if you tell somebody a few hard truths and they don't like it, have you unknowingly created an enemy, or do you know what I mean? Let's go back to Pictet because I'm really interested to go on.
I wanted to catch you on the in particular on the private bankers becoming group heads and then country heads.
Yeah,
I do sincerely believe to this date that private banking is not a very scalable business in terms of the efficiencies that the organization can provide. I think it's a scalable business. You want more business, you hire more private bankers, and you need to hire the right ones. But contrary to other businesses, I find that the way the functions are defined and the way the roles are defined are not very conducive to expanding the business. I do find that the group heads very often are forced to relinquish their books, which they don't really want to,
yes,
but then have a limited added value for their individual private bankers. There is still that nagging feeling that clients could be nicked from one to another. If I introduce you to my group head, the group head's value add is maybe a primus inter pares. Some out of 5 private bankers, one emerges and becomes the group head, but his skill set was not materially different from the other 5.
Yes.
What does he contribute to the other 5? It's not the origination because it's not very scalable. It's just hours on the phone. And typically, the stature of group head is not going to be materially different from the stature of a well-rounded managing director private banker. Bringing that guy to the meeting is not going to change much. They've been through the same product training. They've been through the same compliance trainings. The group head himself will not be able to onboard clients more easily. You need to go through a process that's independent.
Correct.
What is the genuine value add? I think that the pyramids are artificially layered in private banking, and the structures could actually be run in a much more flat manner.
Yeah, I find it fascinating because I always feel that the best leaders, I'm very old school in my mentality in some ways because I feel that serving an apprenticeship in different pockets of the bank, as you alluded to with JP Morgan, means that you get to see a bit of everything and you understand how all of it comes together. And I think, the future CEOs of private banks have to be multidimensional. You're increasingly seeing people come from the investment product side. But I feel that you need to have done a stint in different parts of the bank in order to tie it all together. One of the things for me, the biggest dichotomy in private banking is that most CEOs that you're talking to today are not being even measured annually. It feels like it's quarterly and it's monthly. And the reality is when they're talking about 5 years from now, the majority of CEOs in the role today may not be in that role 5 years from now. And when we place people, we have to be very conscious of that because if you're a private banker and you work with, if you're my client, right? But realistically, your father was originally my client. As a family, you're a lifetime, partnership. That's a lifetime clientele. But I think in private banking, when I see people move all the time, it doesn't make any sense to me. So I think it goes back to the fact that if the CEO knows that they're in power for long enough to get things done, and they take their time to invest in staff, then you won't have that hire and fire policy of bankers, which I've never subscribed to. So I think, as a CEO, Pictet is not a hire and fire organization, right? You will hire very selectively.
We did, but because of the ownership structure, there was a very healthy resistance against quarterly targets, against connecting pay to short-term financial performance. and obviously a resistance against hire and fire. You've got to look at a bank like Pictet, but those partnership-led banks through the lens of the tenure of their partners. And you will see that whether you look at Lombard Odier or Pictet, the average tenure of partners, of the senior partners there, is measured in decades.
Yeah.
The most successful institutions have people who have been there for a long time. And you look at again, the Jamie Dimons of this world, they have led these organizations for a very long time. And they know that if you look at results on a quarterly basis, it is not going to be conducive to reaching big strategic objectives. On the other hand, they also know how long an effort has lasted and when it's time to call it a day. When you regularly change those leaders, either they feel that they know that they have a Damocles sword over their throat. They feel that they need to show good numbers straight away, next quarter, next half year, next year at worst. They know that they don't know how long particular efforts in some segments have been going on for. And so you restart the clock and you may allow some laggard businesses to survive for that little bit longer. Those short-term tenures are actually not something that is conducive to business, in particular in private banking. The time horizon that people have and the successes that I've heard were successes where you maintain relationship, you nurture relationships for years, for half a decade, and then the client who had 2 million with you all of a sudden has a cash event and lands 20 million. The banker who had that 2 million client that was basically in cash had to fight every year to keep that client, not to terminate that relationship. And after 5 years, the big day comes. It's not an overnight success. It's not a coincidence. It's not a stroke of luck. It's 5 years of work, sometimes fighting against the organization to do the right thing and nurture that client that was a 2 million client that becomes a 20 million client and one that will invest for the long term. There is some discipline that is required there, but still the approach remains too short-termist. And the more you go for a numbers-driven approach, for a quarterly profits-driven approach, for a cost allocation approach, the more you're going to chop at the knees these efforts that need to be long-term efforts, because you're dealing with humans.
Yeah.
You're not dealing with cars. Oh, my Golf doesn't sell. I need to discontinue the GTI model and get a hybrid plug-in. Okay, you dial down the GTI production and you pull up the plug-in production. That can happen when you're an engineer at Volkswagen. But the consultants that advise banks just think one model fits all.
Yeah.
I can use levers and cut off unprofitable clients and then increase profitability. You know what? You cut off the unprofitable clients, and it's like chopping the woods in the the trees in the nursery.
Yeah.
Yeah, great. You don't need to maintain the nursery anymore. Where are the big trees going to come from? Oh, sorry, we chopped the trees at the nursery.
Brilliant analogy. Share with me some of the greatest challenges and wins that you had during your time at Pictet in private banking.
Growing the business in a firm like Pictet, which has an immense focus on investment and has very little patience for lending to clients or leveraging clients, which is against the grain here in Asia, was a challenge. But the value proposition that a bank like Pictet offers is that this is still, and I do believe that this is still a bank that offers loyalty to their clients. From the partners down, there is a sense that the client can't be overcharged, is not a cow to be milked, needs to be respected. There is a sense that you are creating a long-term relationship, and the partner who succeeds to the previous partner will want to maintain that relationship. there is that sense that we are in 25-year blocks. Partners at Pictet typically spend 25 years as partners, if not more. And they don't want to churn clients.
Yeah.
They want to create that relationship, that access, and that value over time where we're in this for 25 years. I'm not going to overcharge you for the first 5 years and then you're going to leave me. We're going to have a fair relationship, but you can trust me and I can trust you. I have never seen this type of actively promoted long-term engagement in any other business.
Yeah, the approach is so unique and refreshing.
I do believe that the partnership structure is the purest form of what other banks are trying to create when they give equity incentive to their bankers.
Yeah.
Think about the equity incentives of those poor Credit Suisse bankers.
Yeah.
They were sitting there and somebody lends to Archegos and they lose a few billion, the stock price tanks, then it gets taken over by UBS.
Savage.
You had nothing to do with this, being a private banker serving your clients here in Asia.
Yeah.
So that type of incentive is intentionally correct, but it's practically flawed. When you look at partnerships in Swiss private banks, you've got to admire the fact that there is a genuine, direct, long-term interest in preserving the future of the firm, but preserving the relationship with clients as well. I would add one more thing. And again, this applies, there's so many examples that would jump to your mind when I say this. But when you are a partner in a firm for 25 years and it's your money on the table, why would you try and pursue U.S. tax evaders as a client base? You just wouldn't. You look at the Pictet partners, they return 22, 23, 25% on their equity, on their investment in the firm every year. Do you really need to make it 27 and take an immense risk of doing something unethical and illegal? There is no need. So that partnership structure, when it's well run and it's profitable, is in fact the best buffer against irrational, illicit behaviors where people think, I'm going to go into this investment bank, I'm going to do this big trade, we're going to make blob, I'm going to be paid 10 million, and you know what? It blows up in 3 years.
Yeah.
Okay, I get fired, but I've got 80% of that, if you're lucky enough to be taxed in Hong Kong, I've got 80% of that sitting on my bank account. I'm golden.
Yeah.
You see the difference between those two approaches.
For sure.
And this is one of the things that I've admired in the traditional partnership-led Swiss private banking industry. Have I met the smartest people in the financial industry there yet? Of course not. Have I met the most aggressive people? No. Have I met the most hardworking people? No. But I've met people with that very pedestrian, balanced, long-term sense of ethics that I think every client should seek.
Yeah, for sure.
For full disclosure, I don't have any relationship with Pictet, Lombard, Odier, Bordier, or some of these more traditional banks. But I do stand by that vision.
I'm curious, if I said to you, what was the best quarter of your career? And I don't mean in terms of revenue or money that you made or earned, but in terms of enjoyment where you have been challenged, where you look back and say, wow, that was a really unusual period.
I mentioned this before in our conversation, but closing that large transaction for Hutchison Whampoa after 18 months the job in Hong Kong, where I was in a new seat. I was trying to prove that there was some genuine, very profitable business to be done. And I presented this transaction to them. This was my background. This was my technical skill set. And of course, the entire Goldman Sachs organization behind me. But I presented that product. We had to have discussion with rating agencies, with lawyers, with accountants, with, of course, the company itself, with our New York syndicate team. And when we closed that transaction, it was one of these moments where you think, I want to pause here and enjoy this moment. It was my best quarter. It was the validation of me moving my family there. It was the validation for Goldman Sachs that there was a job opportunity that was worth shipping a managing director over there and investing into that business. The results came, and no matter how shallow or vain it may sound, but 2 days after we closed that transaction, I got a personal email from Lloyd Blankfein, who was the CEO at the time, saying, this was well done.
Beautiful.
I genuinely think that somewhere up my chain of command, somebody said, hey, we've just done a double-digit profit in an area that we weren't even busy with 18 months ago.
Yeah.
And we made it. This is working.
I'm sure.
I'm sure that Lloyd must have written one email a day to anybody who was doing something great. But getting that was the icing on the cake. And you thought, okay, I'm able to do these things. I moved one of the 3 legs of the stool, and it really proved successful.
I love it. Now, one of the many things that we have in common is the balance between, working hard, playing hard, and health and sport is keen to both of us and central to keeping that balance. Talk a little bit about how you've done that, because a lot of senior people get so fixed with work, and in our business, you have to do a lot of client entertainment, what have you, and the gym or going for runs falls by the wayside. How did you balance that, and how do you continue to?
You and I are both work hard, play hard people. But you do need to take the maintenance of your physical hardware. You do need to take that maintenance as full part of the job. And to give you a sense for that, I do have a lot of stress, and the way I deal with that is by running. It's somewhere between the physical exertion that eliminates toxins, that brings you a better sleep, and just the time with a bit of music in your earpods. That does it for me. When I lived in Hong Kong, Goldman Sachs' offices were at Chung Kong Center, just at the bottom of the Peak tram station. And I used to live at the top of that very same Peak tram. So
it's an unusual journey to and from work, right?
it is. When you take, in the morning, I would take the Peak tram down together with a bunch of bleary-eyed security guards who were finishing their shift, the night shift. But in the evening, I would come down with my jogging gear.
Yeah.
I would put on my jogging gear, my running shoes, and run what is a 400 meters stairmaster up the
That's
Peak
no
back
joke,
home.
though. That's no joke.
It was a 25 minutes run uphill.
Yeah.
Literally from Central to the Peak, and it was 25 minutes. It was not much. I would do that 3 times a week, usually at night or late at night, because you finish relatively late. And that was my week routine.
Yeah.
My weekly routine.
You preserve the engine, right?
You can't run the marathon every day. I'm not David Goggins.
Yeah.
But you do need to have that routine where you say, no matter, and if it rains, it was even better, because it was a bit cooler.
Yeah.
But you need to do these things, and you need to maintain that. You need to, and I don't want to sound too shallow, but you need to look at your weight and make sure that those corporate dinners and those jet lags don't get the better of you. As soon as you're on a slippery slope, then you get more tired when you run up the hill. You get to your week of winter sports, and you're not fit, so you don't enjoy yourself for the first 3 or 4 days. You do need to keep that machine running. And by the way, sometimes you turn down the client dinner and say, I'm sorry, I'm not available, because you need to go for your run. You need to prioritize that. This is the best possible advice I would give to anybody who feels close to burnout, too stressed, at home or in the office. You just do need to get the machine going.
You know what? It's so refreshing hearing you say that, because now a lot of my internal meetings we go for a walk, right, with some of my senior guys. And although last week I did it with Isaac, we went up the Peak Trail, but we weren't doing much talking at the beginning because it's quite arduous. But the other thing I've started to do is I will invite 1 or 2 of my clients who, when you hit your mid-40s plus, we're all going through that same physical journey, and we'll go for a walk instead. It's a little bit different, right?
You are so right. And I do think that we need to change the idea of bonding over a lunch or a boozy dinner.
Yeah.
let's bond over a 10K walk around the reservoir,
Yeah.
or double walk, whatnot. It is just as healthy. You create as much a connection.
Yeah.
You have more time to share, and it's healthier.
Yeah.
You're going to come up with your endorphins up.
Yeah.
So is your client. This is the perfect thing. Where have we gone
Yeah.
to forget that this is a possibility?
Well, the other thing I like to do, but you have to find the right places to have foot reflexology. When I'm in Hong Kong, if it's like, say, 2:00 in the afternoon and the place is empty, because normally if there are multiple people, you can't talk, because I love foot reflexology, and it's actually part of my health routine. But if you do suggest it to the wrong person, they will look at you strangely.
I think this one is a bit
too
touch
far.
and go, but point taken.
So let's talk about entrepreneurialism and this current part of your journey, because I'm fascinated about it, having taken this path myself many years ago. Talk to me about what you're doing now, please.
After leaving Pictet, I realized that the private banking industry is moving in the right direction. You hear those buzzwords, intergenerational wealth. You hear the words holistic approach to wealth. There is a service that is offered around wealth planning, which is very often a glorified way of talking about tax optimization.
Yes.
But you do see that the trend is moving from what private banking was 30 years ago, which was just offering you access to the markets, to that one was that competitive edge was negated by online brokers. So then the value add of private banking had to be more portfolio management, but then portfolio management became a little bit more commoditized. So you had to move into real assets or private equity and less liquid assets. So you can see the progression every time technology catches up with the service that private banking offers. Private banking slowly finds the next avenue to explore and the next way to add value to their clients. It is great. What we now have in that industry is merely pointers. How do you deal with intergenerational wealth? We can advise you on philanthropy. We can help you holistically. And so far, that good intention is there, but there isn't any quantitative tool that allows you to offer what you just described to your clients. So if you've got a client with 3 kids and half a dozen properties around the world, portfolios with 3 banks, some private equity investment, left or right, all this spread between Australia and the US West Coast with a dollop of investments in Europe, how do you make sense of all of that? What I've seen is that the best private bankers for the bigger clients would sometimes try and put together an Excel spreadsheet and make some sense out of it all. But there are no tools out there that allow you to easily map a client's wealth separated in different vectors depending on which family members owns what.
Yeah.
That you can stress test, where you can assess some FX vulnerabilities, and where you can model some various scenarios saying, oh, you, Mr. Private Banker, have suggested me to buy another 3 million of your private equity fund. What does that do to my entire wealth? If I put 3 million in cash in that private equity fund, it becomes illiquid. Can I survive without those 3 million of liquidity? How do you handle that quantitatively? And this is what we've embarked to do at WM Cockpit. I thought, it seems that nobody is doing this. Why don't I give it a go? I did a little bit of due diligence, and I got convinced that the fintech or the wealth tech part of the world was not cottoning up to that as yet. So together with my co-founder Chris Morris, we embarked on that journey to develop a platform that would do just that. We did not succumb to what wealth tech or fintech does these days, which is to try and say, I'm going to aggregate as many sources of feeds as possible, and I'm going to rehash this into a product that then I can sell, and the only thing I need to do is to press F9, and this is going to work. You get results, and it's a fully automated process. Sadly, and we've touched upon that before, this is not how private banking works. there is no feed that is going to tell you that your client has got a house in Sentosa that is owned through a BVI. There is no feed to tell you that your client owns 25% of a shoe manufacturer company in Vietnam. You can't feed that. You do need to have the discussion with the client. You do need to get the manual input. And then once your model is fully populated, of course, if there are some feeds available for portfolio values or bank deposits, you can put that in. But to get the holistic perspective on your client's wealth, you do need to have that discussion. Oh, you've got a house in Sentosa and there is a 20 million Jackson Pollock on the wall. That doubles the value of the house. There is no direct feed to say that you've got a Jackson Pollock on the wall. So once you've had that discussion with the client, once they've opened up, used you as a trusted advisor, and you can get a sense for how that wealth stacks up from very liquid real estate art all the way, of course, to portfolios, then you can provide a completely different type of advice. You can talk about liquidity. You can talk about fairness of split between the children. You can talk about modeling, stress testing. You can talk about assessing how a new investment would complement or actually over-concentrate you in a particular sector. These are things that were not available. This is what we are developing at WM Cockpit. I was frustrated sometimes through my private banking days because I felt that the opportunity was there to engage with clients at that level, but you can't spend the right amount of time, even me with my corporate finance background, with every individual client. You can't do a specific Excel spreadsheet for them. And your average private banker is more busy with investments and compliance and monitoring to have the time to engage into that type of that level of dialogue with their clients. And of course, sometimes it's not their job. They don't have the capability to do so. Last but not least, the wealth planners who would be the right people to do that very often focus on the tax and structure, but not on the finance and quantum. So this is where WM Cockpit came from, is the idea that there is a big empty niche in this market.
And that whole 360 view, right? To understand, because if a client is multi-bank, they may not share with you the inside out of how much money they have part with the other banks. And
you are so right. You must have been a private banker in a previous life. You actually have met quite a few of them. So.
I've met a few.
So the answer there is that we've calibrated and designed our model so that you don't need to tell me that you have an account 12347K with UBS.
Yeah.
Just tell me Swiss bank account or tell me European bank account. Give me the quantum that is on there. Give me the broad geographic split of the assets. And a few more data. So you don't need to tell me that it is an account with UBS. I won't be pestering you saying, how is UBS doing?
Yeah.
But at least we can get the numbers right with either you tell me this is my UBS account and I'm giving you the feed, or you tell me this is a Swiss bank account, or you just tell me this is a number and this is a financial asset. We can go as granular or as anonymized as you want, but at least we need to get the quantum right.
Have to.
And once you've got the quantum rights, then you realize, oh my God, I'm a global citizen. I'm completely overexposed to Singapore dollar for whatever reason. We need to hedge out of that. We need to put on some strategies. We need maybe to borrow against that Sentosa house, create a mortgage that is going to balance my asset and liabilities from a currency perspective. That's when the dialogue starts. And we're not talking about your 5 million portfolio with Bank XYZ. We're talking about your 50 million estate.
Yeah.
Imagine the transactions that you can do. Remortgage this, redeploy that cash, switch from this investment to that investment. Just because one investment causes too much concentration in a country or sector. You demultiply the potential of what you can do with your clients within the financial sphere. We're still talking about making financial transactions that will be profitable for you and that will make a lot of sense for the client. We're not talking hard selling, hard to understand structured products. We're talking about genuine advice with a capital A.
So if I'm a client, how would I engage with you? How does it work?
Typically, we do have at this stage a B2B model. And so our clients would be family offices, multi-family offices who would come to us and say, can we have access to that platform. We typically offer them a demo if they like it and want to test run it with one client or two clients.
Is the technology tailored, or is there a house model which they can then use?
We white label it for them.
Okay, beautiful.
So if they have a special Pantone palette that they use for their presentations, if they have a special font that they want to use, if they want to have their logo on the front page, it will look, taste, and smell like it's their product.
By the way, I think white labeling is just so powerful. We're trying to do that with our gin business, but where you can, produce the bottle of gin that you want with the label that you want. I digress. So you're sitting down with a multifamily office. You're showing them what typically have you seen that the multifamily offices have in terms of the technology platform?
The ones that try to address what we are doing would do it on an Excel spreadsheet. They do have a number of platforms, anything from Adepar to Canopy or Collation AI as it's now known. They would use this to consolidate portfolios.
Okay.
And these are external platforms that allow them to do some aggregated financial assets management. But what we do is 1, 2, 3 steps further, which is that we aggregate any type of asset. We do have some AI bolt-on modules that actually keep giving you news feeds on the assets that you hold, that you're interested in. If you have a house in Sentosa and something sells in your street, you'll have a pop-up saying, "Hey, there is a
so interesting.
There is a house that's sold in your street, and these are the details." It may or may not be fully tailored or targeted. AI is still subject to sometimes hallucinations, depending on how you prompt it. But we try to get rid of that. There isn't anything that is done to the extent that we do it.
And then, without going into too much detail, but like, how do you charge for this? Is it per month, or there's so many different models of charging and pricing?
Yes, typically for external asset managers, we charge as a function of the AUMs that they manage.
Okay.
When we look at larger institutions, we typically have a license per banker because the servicing cost becomes higher. You see an EM, you train one person and they can deal with their 20 or 30 clients. When you look at larger institutions, every single banker who wants to use it won't have the full level of knowledge or expertise. They will call on our help desk, and the cost start increasing for that particular reason. So, and on the other hand, it's harder to get to charge those larger banks as a function of their AUMs, because some of those are accessible, some of those are not, for the purpose of...
But if you think about what you're talking about, it is applicable for so many people. And if it's deployed correctly, because, I'm on the verge of hiring a new assistant, and I was trying to sit down and I wrote everything down in terms of, okay, this is me, I call it the Quinn group, and I have this company here, offices here, property in these different locations. I'm a dual passport holder, and I've got account, and it's actually not glamorous at all. It's a real headache, and how do you consolidate this and understand it and break it down? And you can literally, if you were a phenomenally wealthy individual, you could have and should have a full-time team looking at things. If you're into property development in different countries, the legislation, the tax, when they change, it's extremely complex.
It is. And so one of the features that we have, and again, that is not seen anywhere else, is the ability to map the legal exposure that you have through your asset holding structure. So if you own a Swiss bank account, a Swiss portfolio, but under a BVI that is held under your Singaporean trust, you will have exposure to these 3 countries, and we can map the chain of these exposure. And if you happen to have everything through some Caribbean jurisdiction, and you want to know what is the risk that there is another Mossack Fonseca, if you remember that, that major data leak, you will be able to assess whether or not you are overexposed to a jurisdiction or another.
Now, one of the things that I'm sure you've been experiencing that I've seen is when you go into business. I've owned multiple businesses over the years is when you start to mix your social and your business network. And because I've always authentically tried to stay in contact with people. And I remember calling a guy once and I say, "Hey, how you doing?" I said, "Oh, can I come and see you for a coffee?" And he said, "Well, what do you need?" I said, "Nothing. And he was quite a little bit aggressive about it, like he thought I needed something. And I turned up, and it was actually because it was his 40th birthday, and had a bottle of champagne, and he felt like an idiot, as he should have done. And but what I realized is it's because that individual only reached out to people when he needed something, and he tarnished me with that brush. But I'm just curious, how has that part of your evolution been when you've gone from being the CEO of a bank, to being an entrepreneur? It's tricky, right?
It's a very difficult balance that depends on what you are comfortable with as an individual. It's based on your backgrounds, on your sense of social ethics, and on your aggressivity slash desperation. It's a tricky one. I have a view that friends are friends and business is business. If you nurture friends, they will be aware of your business. My approach is not to chase them or solicit them for business.
Yeah.
I will have a discussion about what I do. If they want to reach out, they can. But I would rather not compromise a friendship. Or if I come to you and we think we're friends, and if I come to you and try and sell you my business, it probably means that we are acquaintances, but we're not friends. I would not jeopardize a friendship for that. This being said, the reverse is true. When you do business in a proper, ethical way, people who you do business with are going to become friends. You can create a rapport, and that will then feed back into the business in a way that is quite natural, and where you can have that friends plus business relationship.
Yeah.
But
I agree.
My starting point is friends are friends, business and business is business. Don't ask favors from friends for your business.
100%.
Let them come to you.
Yeah, it's interesting because my wife always says to me, the road to hell is paved with good intentions. And you're absolutely right about business. But, both of us have been fortunate, and I certainly have in my career, to have become very good friends with a lot of the people I deal with in business. And I realized...
Look at us.
Yeah, exactly. And I think what your name carries, right? And because I'm so old school, a lot of what I do is on a handshake. Of course, at some point we have to sign terms of business. I was working with an organization not too long ago, and it was taking a while to get the terms sorted. And I said, let's just crack on. We introduced a very senior profile, and they said, well, what happens if we can't agree on the terms? I said, we'll find a solution. And then they said, well, what happens if it's not amicable to you, or we don't pay you what you want? I said, well, if it's not fair, then I probably won't work with you again. But I'm hoping to add so much value that you want to work with me. But I do realize that the world of private banking is changing. And we said this, we probably haven't got enough time to talk about it. We could be here for a week. But in the time that I've been in private banking, which is 17 and a half years now, it's gone through so many different life cycles. But the reality is it's still a very new business, especially here in Asia. And I enjoy observing it. But I do think, you reach a certain level and you realize there's a lot of politics at play. But if you reduce it to the core basic notion of this, do right by your client, then I think people will do very well. I'm curious, when you've looked at the best private bankers you've interacted with, you kind of touched upon this earlier, but what makes them stand out? What is, for you, a great private banker?
I need to go into a full prejudice mode here. and prejudice is not a bad word. Prejudice just means that you've prejudged the situation based on the aggregations of your previous experiences. Let me be prejudiced for a second. In the investment banking world, and remember, I've spent 5 years at JP Morgan, 5 years at Lehman Brothers, another decade at Goldman Sachs. What I found is that people were selected because they were 8 out of 10 across. They were 8 out of 10 in work ethics. They were 8 out of 10 in teamwork. They were 8 out of 10 in compliance. They were 8 out of 10 in technical knowledge of the products. They were 8 out of 10 in marketing and client skills. They were very well-rounded individuals, by and large. What I found in the private banking world is that your private bankers are very different. You have people who are 11 out of 10 in EQ and client relationship. The same person is 3 out of 10 on compliance. The same person is 1 out of 10 in teamwork. They're 5 out of 10 or 6 out of 10 in product knowledge. The ratings are all over the places. And what makes a good private banker is to have that 1 or 2 skills that are off the charts.
Mm-hmm.
The good private bankers need to be supported by good managers who know that when that banker brings a client and has a very profitable transaction, you do need to make sure that the I's are dotted and the T's are crossed on the compliance front, because that's not what that banker does well. Mm. So the mentoring, the shepherding, the managing that is private bank CEO has to do is actually the core part of the job. And that's when you have fantastically well-run and profitable private banks. So there is no answer to say what makes a good private banker other than to say it is somebody who is going to be able to get to a client's emotions, to get their trust, to get their buy-in into the firm that they're working for and convince them to join. And after that, they may be useless at investments. They may be pretty bad at following up on compliance and getting updated copies of passport. But if those guys can bring in the big fish and you can remedy to their deficiencies, then you're onto a winning solution. So there's no perfect private banker. I've seen all sorts of people who had different type of skills and were successful for different reasons.
No, that's a brilliant, look into the window through that lens. And I think also where it's different from any other business is the clientele can come from anything. Your clientele could be an Indonesian rubber plantation owner or highly sophisticated, owner of a law firm, and therefore the types of profiles that will support those clients is very different. The one thing that I've noticed that I feel that the private banks don't do enough of, it's sales training at 2 levels. Number one, because, by the way, I don't think the most aggressive sales guys are necessarily the best private bankers. But I feel sales training to develop client relationships, to bring clients on board. I sometimes wonder if the private banks like the notion of having a certain amount of farmers in the business, because the client becomes institutionalized and the banker probably can't leave. I don't know, but I think there needs to be more training there. And the other thing is the ability for team heads, market heads, CEOs to be able to hire bankers, because what I've noticed is that is very tricky. So beyond one's immediate Rolodex, right, which creates a certain level of nepotism, which I think if it's too strong, you have an unbalanced bank. But that je ne sais quoi, that ability to hire a banker is not easy, and there are only a few people I've come across that really have that. You could stick them in Timbuktu and they could hire a banker, right? But what do you feel about that sales training? Do you feel that is something that is required more of, or do you disagree with me?
I do think you need to put the right tools in front of your bankers. A leopard can't change its spots.
Mm.
Bankers who are introverts but very good technically will not be responsive to a training on how to socially interact with clients.
Yes.
It's just not going to work.
Yeah.
The number of product trainings that I've seen where bankers attend and don't really benefit from you trying to upgrade their product sales skills, it's a bridge too far. Remember, they are the 11 out of 10 on the EQ front. They don't see that as their job. I find that you do need to put the training on the table, and then people will pick whatever they can want and want to use. So it's not what I just described for me at JP Morgan at the beginning of my career. We had a 6-month training program, and everybody was brought up whether they had studied geology. It's an old style apprenticeship, And everybody is ratcheting up their Excel skills, their corporate finance skills, their macroeconomic skills, their memo writing skills. Everybody goes from A to B with varying degrees of success, but there is a hurdle level to reach, and you do need to maintain, remember what I mentioned, my 8 across. You do need to maintain that 8 across.
Yes.
For private bankers, you can help them nudge their score scale on the weaker points, but I have not seen those miracle transformation when somebody was an 11, 3, 5, 7, 2, all of a sudden becomes an 8 across and keeps the 11. I've not seen that happening.
It's so interesting.
This is not a judgment on private banking versus investment banking. It's just to say a lot of investment bankers would be mediocre private bankers.
Yeah.
They would be dry, arid technician. They would shut a client's relationship if they don't comply immediately with the updated photocopy of their passport. They're not tooled to evolve into that more human-oriented environment. So I'm not making a value judgment between one and the other. I'm just saying that the skill sets are very different, and this has some influence on how you can then try and enhance it.
I find it fascinating because I think, it doesn't matter if you're a school teacher and you're trying to sell a curriculum, or you're the principal of a school and you're trying to get, new parents to sign up. The reality is we're all salespeople. But I call that whole notion that you mentioned a bag of books, because if you give people books to read and you force your staff to read them, 99% of the time they won't do it. If they do it reluctantly. But if you give them a bag of books and they'll choose what might make more sense, I find that interesting. I'm just curious, when people at the top, I'm always fascinated about what decisions they made when they realize, I'm deficient here. I need to learn this here. Because what I've always looked to do is, if I see someone that's really strong in a particular area, I'll go and saddle up next to them and try to learn from them and understand that. I mean, has that been your experience?
Yes, we do have a very important part of investment banking, private banking organizations that we haven't spoken about, which is the annual review process.
Yes.
And good managers will be able to spot, and by the way, this could be your good market group head or country head, but these are people who should be able to identify the one or two areas for improvement in individual bankers and offer some remedies. That works quite well. And in particular, when it's in writing, you do have a record of you asking for something to change. You do also empower the person who is receiving that feedback to seek internal training, sometimes external training.
Yes.
I've signed checks galore for people who said, you told me last year that I was not doing this or that enough. I've signed up for that course, and by the way, it gives me credits for continuous development. But I do think that is an important part of the process. Without trying to upgrade everybody in the same way at the same time, managers need to have that targeted approach on what are the one or two skills that would be transformational for a banker to improve, and then put the means at the disposal of that banker.
Well, the interesting thing is, with a lot of career coaching that I do, and the majority of my career coaching clients are very senior, it's interesting. I think they realize where they may have plateaued. They've been in the game long enough to know when they have to rejig things and shift them. But the interesting thing is, I feel that a lot of people wait for their bosses to conduct an appraisal. And I say, look, if that's the case, even if you've got a great boss, you're behind. Because if there are 10 guys reporting into this manager, and you have one person who's the outlier, who sat down and constructed things and are thinking, 12, 18, 24 months in advance, and they're doing all of this, that's the person that's most likely to get further ahead. So I try to help people in that journey. And it's interesting because I don't know if I've ever told you this. I'm really proud of it. I always share it with people. Just over 96% of the people we've ever placed are still working where we placed them.
It's simply amazing.
It's amazing, right? And
it's the best testimony you could have to the quality of the work that you do.
I'm very grateful. It's a little bit coincidental because 6 of the key banks that we worked with consolidated to become 3. But I'll share with you what I think has added to that a little bit. when I speak to these, if I'm lucky, I place a great candidate. So this is origination, right? Execution is when you've placed them. And then it goes back the full life cycle. Origination, they give me some work and I help them build their team. But a lot of the people I've placed, that when they reach a certain level of seniority, they feel that they've plateaued. And then I talk to them, and sometimes they'll engage me to understand, okay, how can that person move within the business? Maybe I'll have a line of sight or an objective insight that they may not be aware of. And going back to your point about looking at your options, I always feel that in order to move up internally, which a lot of people want to, you need to understand what your external options are. And I always joke, I always say, look, don't go and interview nilly-willy. You can explore the landscape of the market. But I use the analogy that, if you're a married man or a woman and you meet a lady in the evening in a bar, even if you don't go up to the hotel room with a lady, you've crossed an invisible line. And if you start interviewing elsewhere, before you know it, your mind is wandering. So I always say to people, try to explore how far you can go in your current organization, because as you know, the grass isn't always greener. So that if you do interview, you're interviewing for a reason, you're interviewing with conviction, and you're more likely to do well in those meetings. And I think when that happens and it's real, that's when the move happens. I find it fascinating because I think the younger generation move jobs very often, and I think it's okay to move, but I think it takes time. Like any private banker that moves every 3 years, I always try to understand why, right? And I always ask, like, I'm not a fan of job descriptions or CVs on their own. Of course, they hold a lot of value, but I will never really listen to my colleagues' insights into any individual. I will sit down and try and understand. So, for example, if I speak to a banker that covers the Singaporean market, I won't assume that he only wants to cover the Singaporean market. He might say, well, actually, in an ideal world, what would you like to cover? I'd love to cover North Asia as well. I can't because of the construct of the bank. Okay, let's talk a little bit about that. And it's the same thing. I feel that when you're in an organization selling something, the problem is 9 times out of 10, you will only sell what that bank can sell. But I think there are ways. So, for example, if you don't do aviation finance, do you then just, pass it on to another bank that does? I will try and find a solution and let the client know that I've got his or her best interests at heart. And in so doing, even if I'm not going to make any money, I still service the client. I look after the client, and they know that I've done that for them, and they'll come back to me. Hopefully, again, if I can get a third-party referral, make some money from it, that's what I would do. But it's fascinating, your insights. So as your journey continues as an entrepreneur, what's next, and how are you planning to develop the business?
Once you get into a tech vibe, there is always a way to improve your product. And in particular, when you haven't developed a product because it could be developed, you've developed a product because you've got a purpose, an experience, because you've had clients who are in specific situations and you want to address an ever broadening spectrum of issues or potential transactions. So developing the product is the first thing that is on my mind, and we already have a number of features that we are about to roll out that will make the product even more differentiated and unique. The next thing is that there must be a room for a B2C version of that product. What I've described to you as what private bankers do for very wealthy clients could be done in a smaller scale, in a more foolproof way, by private individuals. You don't need to have billions to use this product or draw some benefits from it. Of course, if you have the 3 assets, if you've got a savings portfolio, your CPF, and your house here in Singapore, and you live in Singapore, there isn't much of a benefit in getting into a more sophisticated analysis. But very quickly, as soon as you start owning assets abroad, as soon as you start thinking about splitting these between various children, you start getting to a number of issues. You don't need to be a billionaire to do that. So the idea of offering something to customers that is available by subscription is one that we are toying with very seriously.
Yeah.
From there on, if you upload this software, put in your data, and then sign up for some blind marketing, JP Morgan may say, well, there is a client X from WM Cockpit who has accepted to share data with us, and they've got a 6 million portfolio. Why don't we send that client a version of what we would do for that portfolio? And so you have an added tech layer that comes on top. And that, of course, is more, for the time being, we are more of a SaaS business, because we're B2B. But you could imagine us being a B2C business,
100%,
and this becoming something that is more widely used in wealth planning. And so far, every time that I have a meeting with a VC, they say, "Oh, but XYZ already does this, and they do wealth planning, and they do this." The only thing that all of these platforms do is to compound your financial assets, is to aggregate your portfolios and compound your financial assets and try and figure out a Monte Carlo simulation-based outcome as to when you can retire. People do have those financial assets. Usually it's a fraction of their entire estate. They have more shop houses to rent. They have properties that they've put in the names of their children. They have a couple of family businesses. None of that shows up into those, what I would call those tech fin businesses. It's not fintech. It's technology first. Let's try and see what we can connect and then figure out whether there's a financial application for it. The tech fin stuff is everywhere, but it's useless. What we are doing is saying, what would our clients want? And then we start building the platform to deliver it. We're going completely...
You're re-engineering the whole process.
Yes. And to be honest, there are some things that I said are not and will never be scalable or fully automatable. Your house in Sentosa owned through a BVI. Good luck to try and find a feed that gives you that. It's just not going to work. You do need to have either the private banker who's going to help you through this reflection, or you should be able to populate that yourself when we get that model to B2C. But these are the avenues that we have for development.
Well, what I'll do is I'll put a link to the description for your website, your LinkedIn profile, into the YouTube account. Dom, thank you. It's been an absolute pleasure. Thanks for taking the time. Is there anything else that you wanted to cover?
I'm very grateful for the opportunity to discuss these issues with you today. And I would just like to say that whatever we have discussed, in particular around private banking industry, is something that people should take note of. There are too few headhunters who think in terms of the strategic function of the business, the compatibility of people to organization, and they just think bums on seats, moving, and literally I find the word abhorrent, but moving a banker from A to B. This is never what your business is about. And I've really appreciated over the years how you look at that stuff as being finding compatibilities or optimizing the match between a banker's capability and another organization beyond its current employer. That's your 95% retention rate. And I just want to congratulate you for that, together with thanking you for having me today.
Dom, it's been a pleasure. Thank you.
Thank you very much.
Cheers.
Cheers.